Okay, hello everyone. Thank you for joining us today. I'm Toby from Yieldlabs. Today I've got with me Steve from Yieldlabs, and I've got
Hi.
our amazing guest, Jonathan Libby from SteadyState Finance. So I guess we'll just dive straight into it. And John, do you want to give us a little bit of a background on yourself? Like, first of all, like what got you into crypto? What got you into the insurance sort of part of crypto, and what got you into all of this?
So I fell in love with DeFi and crypto in the fall of 2019. My professor at my university was named Leighton Cusack. He was a founder of a product called Pool Together, and founder and CEO of a company called Pool Together. It was one of the original DeFi protocols back in like back in 19 and 18. That back when no one was taking the space seriously. And when Leighton showed me Pool Together, I thought it was a great concept. But what I loved about what they use is they use compound finance to generate yield by the second or by the hourly. And it blew my mind as a finance nerd how you could make that even possible. And from there, I knew DeFi was the future. Whenever I went about crypto, or I wasn't like I was researching, I was studying for fun, but I didn't necessarily like do the deep dive, or the sense like I was doing the deep dive, but I wasn't like I'm in the space yet. I wasn't the degenerate that we all are. And
Right.
he kind of, but when people brought up crypto to me, I always look at them like, this stuff's the future, right? And they look at me funny, like, what do you mean it's all Ponzi? Like, no, you actually research this stuff. Well, really invigorated. And I actually bought the March dip. That was my conviction, the COVID-19 March dip. I got very successful there. But what really brought a lot of my convictions in about, if there's any question at all in myself, was you're in finance. And seeing when I deposited USDC in a smart contract, you'll find it's the highest APY lending between synthetics of a compound and other lending protocols. That just showed me what that could do, the innovation could bring to banking systems, and how you could actually raise the APY in banking systems rather than lower it. And so ever since then, I kind of want to fall in love with DeFi and crypto. I've been involved in the space, been very active, a lot of governance forums. I got involved in the perfect time, really, like when I was really working in protocol communities was DeFi summer. You guys will never find my Anon account, and so you'll never know what I was actually really involved in.
There's a challenge, guys.
Yeah, right. But you guys will. I have like 5, but you guys like it's just really kind of fell in love with the space, and that really kind of led up to SteadyState. We're building protocol insurance, which I actually met one of the co-founders at Yieldapp on a governance forum. And
Oh, cool.
from there we kind of built out from there with the relationship. My background in insurance, you also asked. I've been involved in insurance since 2017. I started, in PNC life and health, but I learned under some pretty brilliant people, and I was very active. That was my first finance exposure, was insurance. And I kind of learned under a guy named Richard Vasquez, who's pretty brilliant in the life health and PNC space. From there, I actually got to learn under 2 other great mentors, Ronald Latz, who's a former CFO at AIG, and Michael Engelhardt, who's a former COO in the American division for the Lloyd's of London. And so I actually got some serious exposure to some of the best minds in alternative insurance, and a bunch of hundreds of, like, not hundreds, but tons of insurance models that no one my age should have that exposure to. And I could actually,
Right.
using my creative mind, I was able to put pieces together and build something.
Yeah, I guess that like your exposure to that, and you're obviously young and so on, it lets you see a gap in something that you're interested in, which is obviously the crypto space, and then that leads you on to steady state, I suppose.
Yeah.
Steve.
Cool. Yeah, thanks for the intro, John. Really interesting background. So steady, then just give us a background of what steady state is, and sort of how it works for rich users, or for the protocols that you're working.
So steady state, what it is simply is insurance for protocols. I remember doing research. I was hired as a consultant. One of our first clients was yieldapp, where we're customers working to bring me as a client partners. And one thing I kind of learned, yieldapp kind of contracted me to build an insurance solution for yieldapp. And I remember when you first want to build a solution, you have to first identify a problem. And they said, we can't get insurance. I'm like, well, that's ridiculous. You're at a fintech. And I started doing a lot of research, and I found out there was no insurance during the February last year, insurance for protocols in the industry. And I was like, wait a second, what? And I was just like, and I kind of looked at it, did a lot of research, and I found a lot of key problems why. for why there isn't insurance for protocols. First of all, people are not providing enough capital in the pools to really provide meaningful coverage for a protocol level exposure event, rather than self-focused on retail. But protocol level, and I think the reason why was yields were very, very low comparative to the chance of losing capital. And so I looked at that model, I'm like, okay, and secondly, there were no policies yet actually written to cover protocols at that time that were really effective. And the third biggest problem I found was protocols did not entrust insurance models as they were currently built. And that was the mutual system model. Then how the mutual works in DeFi and crypto is if I provide capital, say you want $100 of insurance, Steve. If I provide you $100, and Tobi provides you, maybe I provide 50 and Tobi provides 50 to insure your $100. If we agree on an event to pay you out, how it works right now in the mutual is you basically, the event happens and you go to Tobi and myself to get the payout that we promised you. Tobi and I decide whether or not you get our money. And so that was a model, even though it's put in a smart contract, we're the ones voting to input yes or no for payout. And protocols didn't trust that model at all. They're like, who's going to look out for us? These retailers aren't looking out for themselves. And you see that in the approval or claims rating, where it's about 18% approval on claims.
Yeah.
No protocol is going to want that. And so steady state, what it came to be is I kind of realized, what are the models, in insurance where you can actually create a more trustworthy model on how to insure a business? A lot of the problems, you can't just create a blanket term business insurance for protocols, at least in the original model. And the reason why is I don't have a $500 billion lying around where I can promise to insure a business and receive massive premiums and just create the payout. So if I promise to insure a business, I cannot actually pay them out if the event happens, which is fraud. And a lot of the people starting to create insurance for protocols, that's where they are right now, making these promises they can't keep. And so what we're doing is we're applying to something called parametric insurance model. Parametric is an agreement where we agree to pay out a protocol a certain amount of value, basically pre to an event happening, and the payout happens if a very specific criteria is hit. This is what people use. Parametric insurance is actually an alternative insurance, very different to a lot of insurance models we see, from like car insurance or life or house insurance, where in these kind of insurance models, crash happens and you get a payout, versus you agree to the payout pre to the event. And the criteria we use, this is agreed upon pre, which is similar to earthquakes, floods, and other different kinds of events like that. And looking at a lot of history, technological risks, people are starting to argue in white papers, are likened to these kinds of catastrophic events, which makes parametric a perfect use case to cover a lot of events in DeFi and crypto, which are actually technological events that are catastrophic, which makes it very perfect to build this model. What this does now is, rather than going in and evaluating the payout for a protocol, we say we offer a certain amount of value, and pre to the payout, basically the value is agreed upon. But rather than insuring them directly, so for them, they have a model where it's a clean, concise model now, where they know whether or not they're going to get a claim payout, rather than us voting on a system. And that's how you can, and that begins the process of automation, which you can go more into detail there. That's the base layer framework. And so what we do rather than insure the protocol directly, this is a steady state I'm really kind of diving into, and what we're doing in protocol insurance is, rather than saying bring a $30 million level of coverage to the protocol, we know we do not have $30 million lying now, at least right now. So protocols post these things called coverage pools. Aave wants coverage for their downside risk to cat exposure, catastrophic exposure. They're willing to pay, and they decide their premium. They're willing to incentivize people to stake capital and pay a 20% APY in Aave tokens for any money you stake. And you can keep that, so if I put 100 USDC into this coverage pool, I receive a 20% return Aave. So the problem with this model now for the staker is parametric agrees to the payout pre to the event. So Aave will only actually get paid out. They won't get paid the $30 million unless there's a $30 million staked into their fund. So what's going to happen here is people now, the problem with the stakers and trying to incentivize stakers to invest in this model is their upside is a 20% rate of return Aave, but their downside is 100% USDC or whatever they're staking. So you're looking at 20% upside, downside 100%. Now that's normal, let's say, in any kind of model system where you're buying risk or debt. However, I think we could have done better than that. And in order to incentivize capital, I think the way to actually pick stakers and incentivize stakers for capital is effective risk management by weighting downside risk per event on a basis. And how you do that are these things we're building called index pools. What they are simple mathematical structured products where they weight your downside exposure to multiple coverage pools. So if I have an index pool and they're at 20% exposure to 5 coverage pools, my downside is no longer 100% if one of these pool pays out, it's now 20. And the goal is to extrapolate that to 20 pools, 5% loss, 100 index coverage pools, 1% loss. And to really actually, rather than try to say, you're just screwed if the event happens, the payout happens. What we're saying now is we're going to weight your downside risk and actually try to create an actual risk management tool for it'll naturally control your downside while maximizing your upside. And that's what the index pool.
And you can weight these index pools like on a per event basis, like
Absolutely.
You're talking like black swan events, or you're talking about hacks, or you're talking about flash loans and stuff like this.
Yeah. So it gets deeper and deeper how we're going to build it out, because we're actually categorizing different kinds of risks the protocol will be insured for, and then we'll be splitting it up. But at a base level, if a coverage pool pays out, okay, you're looking at a % loss in the parametric, but it's going to all pay out. So, which is what the protocol needs. But for you, the staker, that's bad. So all you do is build a pool and mathematically say your exposure is 5% or 3%. You can make that natural into the mathematical model. This is likened to a CDO, or a credit default swap, is what we're building. And it's actually, there's a lot of precedent in how we're building this, and a lot of people use this in actual financial markets naturally in the TradFi industry. Ironically, we haven't actually touched this space of structured products or alternative finance very much in DeFi. The closest we've gotten to this so far is Saffron Finance, which is actually using mezzanine structured debt products to create high risk rate of return. But we're the next basically group trying to build a model using structured product debt. And we're doing it to cover DeFi risk. Now, what makes deals attractive here is, okay, if you have a lot of protocols, the problem we see a lot of these different kind of insurers is that the premium APYs are super, super low for staking capital. I can get a 2% return on USDC by buying into a pool in Nexus Mutual. Screw that, okay? What I really want, okay, is high APYs. Business premiums naturally pay APYs. The problem is there's a lot of capital available to get insurance, and there's very little people willing to get insurance on the retail level. But with protocols, with the parametric, it has a fixed upside. So the protocol only pays a premium. They want to pay a 20% rate of return premium on $30 million. Rather, they're going to pay 20% on whatever is collateralized. So it scales well. If it's $20 million, they're still paying 20% of the $20 million. And they're paying 20% up to the 30 million, let's say. So it keeps the APYs high naturally, where it's fixed at the 20%, but it doesn't necessarily, it doesn't decrease because you can't over collateralize the fund. And if they want to increase it, they'll have to set a new rate for the increase. And so what this will do, okay, what this will do on the increase rate is, basically, if you have an index pool with 5% exposure to 20 protocols, and you're collecting different APYs from all these different governance tokens, is you're naturally controlling your downside risk as a hedge while accumulating 20 tokens naturally on a high APY rate and generally accepting it. We control and weight the downside risk while getting you tokens that have speculative moving value to the USD, which allows you to turn that upside from 20%, let's say, could actually turn to a 50% or 100% return because they have moving value, which makes it naturally attractive. If you're a whale in DeFi or crypto and you see a top 100 DeFi index, 1% weighted exposure, and you don't know what to buy, or you want exposure to all DeFi, and if you put $100 million, let's say in Curve, even though Curve is historically one of the strongest projects, you're at risk of losing all your money in Curve. So what you can do then is, rather than do that, why not buy the Curve exposure with an index pool and just naturally accumulate 100 tokens? And when a token moons 100% or 200%, oh wow, I've accumulated XYZ amount of it. Take it out of the premiums that you receive currently and then sell it. And that's the model we're trying to build, is a natural accumulation tool on blue chip crypto DeFis, and allows you to keep a high ROR because you're buying the risk. It's like an Apple.
Really cool.
You're buying an Apple bond and you're receiving Apple stock. Whole new model.
Yeah. It's a really, really cool model. One thing that I want to touch on, sorry, Steve, before I hand it over to you, is you mentioned in there there's some difficulty in getting like retail to buy crypto insurance. And this is, you kind of answered it at the same time, but I just want to re-go over that point, is because it's uninteresting, right? It's uninteresting for retail to buy insurance. It's not incentivized. Like, predominantly, they're perhaps not investing large amounts of money. So it's just like, I don't want to pay 3% on my $5,000 or whatever, I want to when moon, I want my Ferrari and stuff. So it's refreshing to see that like this now is just like an entire new, opening up an entire new opportunity that will also incentivize people with retail to do what we sort of preach at Yieldlabs, is to have like a safe portfolio, and to manage your risk and to manage your downside and still generate plenty of upside. And I think that's really, really great.
Yeah.
Steve, over to you, bud.
Awesome overview, John. Thank you for that. Really interesting. So in terms of the product now, then, what sort of state are you at with the product? And then you mentioned you're working with YieldApp. At what sort of state are you with the partnership with those guys as well?
So when it comes to build out, where are we at with the build out? We're about 25% built out. We've had a product team working part-time. They're all moved on full-time as of literally next week, which is very exciting for us. We've lost a CTO, very, very exciting CTO. Cool. He's public information he's always on the investment material. And we'll be, we have a pretty good team we're building around these guys and girls. And kind of what we're doing now is we're all deep diving the building phase. We're going to hopefully have testnet by late this year, late Q4. Our plan with YieldApp is they'll be very active in the product build, being our first partner. So, we'll be having meetings regularly with the investing team, as well as, the product team and their tech team and their devs, and we'll make sure that we're building something, solution for them, while also keeping an industry-wide solution. We'll have a couple people will be partnering to build alongside this, but YieldApp is one of them.
Awesome. I think there's probably quite a few people watching this that are current YieldApp users, so I'm sure they're going to, if they didn't know about SteadyState today, then they're certainly going to have eyes on this moving forward, and how that's going to help the sort of the overall user experience moving forward. So really interesting. Thanks, John.
Mm-hmm.
Tobi, anything else?
I guess if you don't mind talking about it, then I just would like to touch on the token. I know you guys are going to sort of have an IDO and have a token, and I believe it's called Risk. And I would like to hear a little bit more about how you guys are going to move forwards with that, what the tokenomics sort of look like a little bit. I know you can read this in the white paper, but it's great to hear it from the guy himself while we've got you. So if you could just give us a bit of a summary on that, and any ideas on moving forwards and how that can help the platform, or like governance perhaps, or like what are your plans with it?
Yeah, we're hoping to be DAO day one, and we're going to figure that part out as well. So these tokens will have two current applications. It'll be governance. Obviously, we actually want to build a real DAO governance long term and help work alongside our DAO and eventually have them run the whole system, where we build like an educated model where these guys can build these structured product pools educatedly, effectively, and like be able to build their group. The other thing is fee sharing. They receive a portion of the fees received. Everyone has a
okay, cool.
Fees, so it's going to be that as well. When it comes to other utilities, we're going to be adding more, I think, later with the token. The reason why is recent SEC concerns. We're seeing a little bit of investigations, and I don't think governance and fee sharing will cut it as being a utility. So we're talking with our attorneys and our team. We'll actually work with the group, and we're going to be adding a couple more utilities, and hopefully the DAO will be helping us build it as well. I had a vision to build a DAO before product launch. I saw an article by Synthetics, but I don't know if that's even possible. I was hoping it would. And no one's really, the guy from Synthetics wrote an article recently, and I was trying to find him, like, bro, can you help me figure out how to do this? And he obviously he's so busy, he's not going to talk to me.
Right.
But try to get a hold of a couple guys. But yeah, we'll try to get a DAO ASAP. I'm a big believer in that. That's actually how I got it. That was governance is where how I got my exposure. When
Right.
tokenomics, 450 million tokens will be distributing for a 4-year period. You know, a lot of it is going towards 33% liquidity mining. It's about 27%, I believe, off the top of my head on ecosystems, and 18% team and advisors. 18%
Okay,
team and
cool.
advisors, they're going to be locked up. All team will be ideally going through market maker and OTC desks, and hopefully the advisors will too, to make sure we're being feeding our fiduciary obligations long term to all token holders. And also for we'll also be giving a portion, I believe it's only like 13% to that insurance reserve. You know, long-term vision is you see kind of like we're kind of not really building a typical insurance model in our initial build
Right.
out. And what our goal though is to collect a lot of fees and move into an actual insurance fund that can float on top of this reinsurance model, where it can actually hold the risk, where you have a fund that's like 80% collateralized to all protocols, 20-30% collateralized, but the reinsurance model underneath it that can build. And so we have a vision to actually build to a real insurance model, but we're not going to promise to insure business if we don't have collateral. And that's what we're really doing the reinsurance model. But that's kind of like the reserve. You know, we have a certain amount of tokens we naturally generate to reserve. It'll be a mix of governance, and the governance will hold the reserve, but also the goal is to take it and market, make it and grow it into an actual fund that can start insuring protocols as well on top of our model. That is a long-term vision. And ideally, the DAO will start running different aspects of our system long-term. And I think the goal is to just keep releasing power over time, where they get this, they get this, they get this, they get this, as long as they can show that they can handle it well. And I think it'll be very quick. I've noticed a lot of these DAOs are like it's not like these guys are incompetent at all. You know, they're very competent. They're very well educated. I guarantee we'll have some like Anon JP Morgan guys looking at our system trying to build out structured products, you know? And so it'll very quickly I have a feeling, I'm thinking it'll take like 6 months to go full DAO. I have a feeling it'll actually take like maybe a month, but I'm hoping, because it's just these guys are so smart, you know? So
yeah, that's really cool, man. And I appreciate the sort of the comments on the token distribution stuff. And I think that Steve, that's something that we've seen before, right? If tokens don't get distributed correctly, then like it ends up causing problems further down the line and stunting growth and so on. So it's really cool that you guys have a plan and a long-term vision for what that's going to look like.
Yeah, you know, we're trying to get all investors. Obviously, it's their decision, and advisors. The funds we get, if we get the funds we get when we get bigger names, the bigger names, like they'll probably do it themselves. We're trying to get smaller funds to like go through OTC desks and all these groups, because, you know, just to make sure we're not hurting public. You know, that's kind of the goal. Is obviously it's their right, but we're gonna have that option available for them to go, so that we can do it responsibly if everyone's looking to sell. Which I want people to take profits. You know, everyone should be taking profits. It's just a reality of the model. You know?
Yeah, that's what we're here for, right? We're here for the technology and the profits, right? And the vision of the future.
Yeah, exactly. And get it into the hands of the real hodlers.
Exactly. Steve, anything else?
Yeah, I just wanted to touch on regulation, and I know, well, both the insurance space is obviously very complex, and so is regulation. But the two of them together, like, what sort of blockers and barriers are you seeing from a regulation standpoint in this sort of insurance space in crypto? I'm conscious of time, but if you can just give us a quick high level sort of overview of how that's going for you.
Hot topic in the US right now, right?
Yeah, so. Very hot. So it's really hard. We say we're insurance and we're marketing as insurance, but if you actually look at our model, it's very hard to figure out if we're insurance or not. Because we're more of a reinsurance model, I would say, rather than insurance, and we're a reinsurance moving to an insurance model. But we build these kind of like weird products that like in structured products, and they're meant to mirror the safety of a bond. And we're trying to like, you know, a bond model in DeFi. And so it's like, it's very hard, but to figure out if like this is a security, or is this a credit risk problem? Is this an insurance investigation? Is this a reinsurance model? And what we're going to be seeing, I think, is a lot of people trying to figure out who has responsibility over us, or we could even be maybe a CFTC commodity. You know, I could see that also pretty stemming as well. So it's going to be interesting to see, like, for steady state, you know, who long term wants to kind of like try to bring us in. We want to be as compliant as possible and see who's going to try to bring us in and rein us in. And we'll have to wait, because there's like 5 agencies that could probably try to come after us in very different areas, and one's going to come out on top. And so we have to be very smart about it.
I know you guys are I know you guys are based in the US, right? And I know that even on a state by state level, like the jurisdiction or the law jurisdictions are completely different, even on a county level. So it's insane what you guys have got to try and like be compliant with over there.
Yeah, but we're still doing our best. You know, the goal is to be as compliant as possible. We're based in the Bermuda. We plan to be a Bermuda entity. We may not be a long term. You know, we're going to be cutting the keys to running the system as well as our legal entity over time because we're a DAO. We shouldn't be based anywhere, and that should be a long term vision. Is we need to be on the internet, and we hold that vision very strongly. It's in our values and who we are. We're true degenerates in the crypto space. You know, but we want to see a space, make this a space for everyone, and make this the future for everyone. We're you know, when it comes to our legal structure, we're looking at different kind of entity structures we're building off of. We're not a U.S. structure at all. But right now we're based in the USA, and so when it comes to like our actual structure, we're based in countries with like really strong reinsurance laws because I think we're going to be filed as a reinsurance model. And because of that, you know, we're preparing to make sure we're being responsible and make sure we're being compliant with all investors, meeting our fiduciary obligations, make sure we're doing this everything very by the books as much as we possibly can in a project where there's very uncertainty on what we can and can't do. So we're long term. So.
Yeah, man. I appreciate the vision. It's really cool. I realize that we've taken up a good chunk of your time now. So Steve, have you got anything else?
No, I just wanted to say thank you, and obviously we're all well, I certainly will be sort of keeping an eye on your progress over the next few months. We'd love to get you back in a few months' time, see how things are progressing. But for those who are watching, how can they keep up to date with your progress in the meantime, John?
Well, you have our Telegram, SteadyState DeFi. You have our Twitter, SteadyState DeFi, and their SteadyState.finance is our website. Feel free to hit me up if you want to read the white paper or any of the pitch deck or any of that, just for fun. And you don't have any questions, we'll do my best to answer it. But we're trying to grow a thriving community long term. And you know, we understand some implications, but we don't have a token yet. We're trying to make sure we're compliant when we use a token and all these other things we're trying to do. And but like we're looking to build a community. We want to have some fun. I want to be active with you guys. I've thought about doing something ridiculous like a poker night with the people that are in the community, just in on poker night or something. But other things, you know, to show that we want to be with you guys, answer questions over poker that you guys have, and have a good time. But we want to actually build a really thriving community, and we want to do it alongside groups like Yieldlapp, Yieldlabs, and other different groups we're talking with as well as communities. You know, the long-term goal is to build this world of crypto together, and insurance is going to be a pivotal part about getting us there to the long-term vision. And so we're excited to be a part of that.
Yeah, cool. Okay, so thank you. We'll share those links as well in the description of this video. I best start practicing my poker.
Yeah.
Heck yeah.
Yeah.
Call your Dogecoin betting.
Right. So I will go ahead and put all of those links in the description, guys. Thank you so much for joining in. Thank you to Steve. Thank you to John for his time today. I find it incredibly valuable and really interesting. And thanks again for tuning in.
Great to be here.
Thanks, John.
That's a wrap on today's video, guys. Thank you for tuning in. I hope you found the content useful. Don't forget that you can hop on over to Twitter and follow us at Yieldlabs.